The BRRRR strategy is actually one of my favorite strategies to use when it comes to real estate investing. And BRRRR stands for buy, rehab, rent, and refinance. So it means that you're going to purchase a property. That needs typically a lot of work. You're going to then rehab the property to be, increasing the value, creating equity up front. And then you'll rent out the property as a long-term rental. And then you're going to refinance the construction loan that you obtained into a long-term mortgage. And this strategy actually is one of the most difficult from a bookkeeping perspective because there's so many kind of nuances that aren't similar to other industries. So when you first are purchasing the property, you're typically getting a hard money loan that involves a construction piece. So typically the lender will hold some of the construction funds up front, and you will, as you do the rehab, you will submit requests to your lender for construction draws. So you'll be fronting the money to do some of the rehab work, and then you'll send them proof that, this is the work that was done, and then they'll send you the funds. So you need to have really clean reporting in order to send that to your lender. So that's one piece that's complicated. And then you get to, once the rehab's done, you really want to know, which of these expenses can be capitalized. Most times it's pretty much all of your rehab period expenses are going to be capitalized, but we need to have clean reporting that we can send to the tax CPA to just say, okay, this is what we spent the money on is, how are we going to depreciate this? How are we going to reflect on the balance sheet? So that's kind of the second piece. And then the third piece from a bookkeeping perspective is that refinance, which can typically be one of the more difficult journal entries to book, is because you need to consider where the existing loan balance is. And then you take the refinance closing statement and you book a journal entry based on every line on that closing statement and also reflecting the existing loan to make sure then that you have the appropriate balances on your balance sheet and you're set up, your P&L set up and ready to go for now you have a long-term rental.